What is very clear, and based on the data right now, is that home prices and home rents in Jacksonville are normalizing. The big question here is, what is the Fed going to do with interest rates going forward? We knew that they were going to raise them. We didn't think they were going to raise them at these levels. As the war in Ukraine continues to happen, as China's zero COVID policy continues to happen, as you have these other supply chain issues and the Fed struggles to get inflation down, what actions are they prepared to take? When you're trying to understand, that raises some questions about what demand will be. If interest rates would stay like they are or come down, then we kind of know what effect that has on demand. If they raise interest rates another 3, 4, 5 points over the next year, that could have a whole nother effect on demand. It would have a much stronger dampening of home price appreciation or even price declines if that would happen.
So demand, it has lowered, but it's unclear for the future, but we do know what supply looks like, right?
We do know what supply looks like. So this is the other part of the equation. We just talked about demand. Supply in itself is something that we measure all the time. And it's very indicative of what home prices are going to do in the future on normal years. And so the way to measure this is just called months of inventory. Friends of the show, you probably know this by this. I think we should get some MOI tattoos. What do you think? You know, we talk about it all the time. We love MOI because it helps us understand where home prices are going to go. It's quite simply, if you are a business and you have a whole lot of inventory and not a lot of selling last month, you're going to have pressure to decrease your prices. And on the other side, if you have very limited inventory and things are selling like hotcakes the previous month, you're going to have pressure to raise your prices. The same way in real estate. We just look at the number of homes that are on the market in your area. In Jacksonville, we do this. And then we divide that number of homes by the number of homes that sold last month. And then we have a really good gauge of where home prices are going to be. And historically, between 6 to 7 is that normal average home price appreciation rate. Higher than 7 means that you'd see less than normal home price appreciation, not depreciation, just less than normal. And lower than 6 would be higher than normal home price appreciation. And average home price appreciation is
4.6%.
4.6%. So higher than 7, you'd expect less than 4.6. Lower than 6, you'd expect higher than 4.6.
So if you divide the supply of homes available by the homes on the market for the month, divided by the homes sold in the month, that gives you your months of inventory. If it is a number above 7, then you can expect lower than 4.6% home price appreciation. If it's a number below 6, you can expect higher than 4.6% home price appreciation in the short term.
In the short run, and this is one indicator. This is not the Bible. It doesn't tell you exactly what's going to happen, but it's pretty good. And I want to give you some of that perspective as to why we look at this so intently. So I was investing back in 2006 and 2007, and I saw what an actual declining market looked like. I had a lot of money in the market, or whatever money I had at that time was in the market in rental property. So I was very aware of what was going on here. So in December 2007, we had 18.1 months of inventory. Most people have no clue what that feels like. But when you have 18.1 months of inventory, that's where you look at and you say, well, there's actual declines coming in the marketplace. And that's what we saw. We saw home values in Jacksonville drop 10% over the next 12 months. As we go to June 2009, we had 10.9 months of inventory. So less than 18, we were getting better, but 10.9 still a lot more than 7, right? And so we still had about 10% price declines over the following year there. Now it started to switch right around 2011, 12, getting into 13 and 14. So look, October 2014, we only had 4.9 months of inventory. The rest of the world still wasn't bought in to real estate at this point, right? But we were. And that's when we started to buy as much as we possibly could, because we saw that there was going to be higher than normal home price appreciation. And so you can see 7.3%. Same thing in October 2016, right? 3.9 months of inventory. Now at JWB, you're like, hey, listen, let's get all of our resources together. Let's buy as much as we can because we know this thing's going up. And we told all of our clients that, and those who took us up on that have profited very well from it. Same thing October of 2018, right? There we go. We're bringing this thing into kind of more closely related to where we are right now, right? 2018, we had 3.9 months of inventory still. JWB was still buying as much as we could. We're still telling clients to do the same, right? And you had above average home price appreciation the next 12 months. March 2020. Why do you think I picked March 2020?
It's when the world shut down and everybody was freaking out. And we had just launched this show a couple of months prior. And I remember you saying, I don't know, man. Like, I feel like everybody's freaking out about prices dropping and everybody like losing their job. But I have these stats. What do you think? Do you think I should share this? Do you think I should like come? I'm like, Greg, just be honest on the show, man.
I know. I was scared. I was
Yeah,
scared to
I know.
share it. It's
I
what I
remember.
believe and what we were doing. It was the first time we ever kind of did that, broadcasted it all.
Yeah.
And it was so contrarian. But I said that home prices are not going to go down. But the reason that I said that home prices were not going to go down when the rest of the world said that home prices were going to go down is because of MOI. It was 3.3. And then over the next 12 months, home prices went up 12%. Now here, November of 2022, our months of inventory is 3.1. It is less than what it was in March of 2020. If we were in a vacuum and didn't have all these other things going on and all I was looking at is MOI, I would be really confident that home prices are not just going to stay consistent, but that they would be going up at a rate that's higher than the norm. So this is kind of conflicting here, right? You're seeing on the demand side, we don't know what the Fed's going to do. And that could have a serious effect on demand because Fed's kind of a loose cannon right now.
Yeah.
On the supply side, it's way undersupplied versus the demand that we have. So it's a tough time to say exactly what's going on. So we're looking at all the early indicators that we can, and we're paying attention to the Fed. Another thing to pay attention to here is seasonality. Mm-hmm. Right.
Well, I mean, yeah, you've been talking about seasonality for a while, right? Because while there is this like MOI statistic, you've been saying for like 3-4 months that headlines were about to happen saying that prices are dropping.
Yeah. So what I knew would happen is that the headlines would talk about how the number of home sales has gone down, and they would talk about how home prices are dropping. And they would say, oh, well, this is the next 2008 crash. And what I have shared with all of you is I didn't want you to buy into that. Yeah. Right. There are economic indicators that would indicate if we were going to 2008, but the fact that home sales have dropped and the fact that home prices have dropped a little bit does not indicate that. In fact, what I did was actually put the data behind what a normal drop in home prices due to seasonality would be. And I wanted to compare where are we right now in Jacksonville's real estate market compared to what normal years are. Like, again, been doing this for 17 years. Nobody ever asked me and nobody ever got concerned the fact that home prices went down from June to October in any other year. It's like never been brought up once. But right now, the fact that home prices have gone down from June to October, all of a sudden people are saying the bottom's about to fall out. It's just not real. Yeah. You go from 2001 to 2021. I went and looked up all of the June median home prices, and I looked up the October median home prices. Took an average of both of those. And on average, we declined 4.5% from June to October in every year from there, 20 years. With the exception of 2020 and 2021, 100% of those years, there was a price drop from June to October. So the fact that home prices are dropping right now, it's not atypical, right? That is the way things happen.
Yeah. And according to these numbers, they're dropping less than the average price drop usually, right? Because you're showing this idea that this year it only dropped 3%.
And that's where we are right now. Now, to be honest, these numbers can fluctuate a lot. So at the end of November, it's more than 4, whatever the comparison is. Don't be surprised. But what I'm showing you here is that this is not a declining market right now. And what I want you to get out of your head is that this is not 2008, right? So what is very clear based on the data right now is that home prices and home rents in Jacksonville are normalizing. And when we think about what is going to happen over 2023, there are more questions than answers. It is hard to predict what's going to happen for home prices. So I wanted to tell you our best guess. I think it is highly dependent on what the Fed does and what they do with interest rates. If the Fed would do what they say they're signaling they're going to do, which is to keep rates kind of consistent over the next year, raise them slightly, but kind of keep them consistent, I could see that home prices would actually go up next year. Now, if the Fed gets more aggressive because inflation is harder to bring down, which is also a very plausible scenario that we're in, and the Fed gets more aggressive with interest rates, I could see home prices going down next year. I think if you had to put a number on it, you could see a max of home price appreciation maybe over the next 2 years of about 5%. And I think the max of the decline over the next 2 years would be about 10%. But I think it's just so important. It's important to be a part of this community. And it's important for me to be able to understand what the Fed is doing and bring that to you. And of course, our entire team to make sure that these investments are built to perform regardless of what the Fed does. But I think that is the real question. What is the Fed going to do? That's what's going to affect home prices.